especially very important for the startups. He's very experienced on entrepreneurship and also other topics as well. And he was a Harvard University instructor. Are you still, by the way, giving lessons or trainings in Harvard, by the way, Sam?
Not anymore. It's hard to teach classes when you're back in proper startup life. So
that's right.
I stopped teaching.
That is true. So, Sam, if you are ready, stage is yours. We are going to also start the live stream on YouTube, and we will get the questions at the end of the session. So I am online, but I will keep my microphone off and camera off. So thank you very much for accepting our meeting request, and very happy to see you online as well. And we are excited to listen to you.
My pleasure. It says your event has not yet started. Do I need to click start event?
Yes. Perfect.
So now people should be able to hear us, right? Awesome. All right. Well, thank you all. Thank you, Barack, for that introduction. My name is Sam Mallikarjunan, formerly instructor at Harvard University. I was the head of growth at HubSpot Labs and the chief revenue officer at Flock.com. I actually recently got together with some other former HubSpotters to launch my own startup, OneScreen.ai. So you guys are going to get to see, I've sprinkled in some examples of the stuff that we're working on just so that you can see an applied version of the sort of things that we're talking about. We're going to go fast today, but you're going to get the recording, and you can always reach out to me afterwards if you have any questions. We're going to be covering advanced growth economics and analytics for startups. So the first thing I want to start is a caveat. Marketing is a subset of business, is a subset of economics, which is a social science. It's not a hard science, right? You're not going to be able to, every time I drop a pen on the ground, 100 times out of 100, it's going to hit the ground. Marketing is about how close can you get to understanding, the way that people make decisions and the things that influence them. All of the math that we're going to cover today is just a way to simplify and express the lives and decision-making journeys of your customers. There's two types of data I want to talk about today. One is explicit data, so things that people tell us, things like survey data or ratings or feedback. This is things that people tell us. And then implicit data is things that people show us. How are they using our application? What do they buy? Also the lack of behaviors, for example, abandoning a shopping cart on an e-commerce site, etc. So explicit data and implicit data both have their strengths and weaknesses, and they can be used to create a more full picture of how our startup is working. We're going to cover this framework here that's called the startup to scale up framework, and it's split up in 4 phases. The first phase, the beginning of any given startup, is finding product market fit, which we're going to go over the definitions of, but it's basically like, do you have something that people want to use? The second phase is getting the math to work. So if you're raising money from investors, for example, can you grow your business quickly and in a way that has efficiency and profitability? The third phase is getting the math to scale, because an investor doesn't want to give you $1 and have you give them $3. They want to give you like $1 million and have you give them $3 million back. And then the fourth phase is where growth begins to slow down, and you need to think about things like creating new products, etc. So we're going to focus primarily on the first 3 phases today. One caveat I want to make sure that everybody is aware of, right? You can't do everything at once. If you try and boil the ocean with a match, it doesn't make it a bad match, it makes it a bad plan. I tell the team all the time, who chases 2 rabbits catches neither. It does not matter how much you need both rabbits to make dinner for tonight or whatever. You can still only do one thing at a time. And this is a really common mistake for startups. Before you have product market fit, you try and scale your revenue. Or before you have your unit economics working, et cetera, you try and raise capital. So focus on one phase at a time and focus on the metrics that matter. Don't pay any attention. We're going to cover a lot of metrics in this, but depending on the phase your startup is in, ignore all of the other metrics. So phase 1 is finding product market fit. My favorite quote on this comes from Henry Ford, where he said, if I'd asked my customers what they wanted, they would have said a faster horse. Another framework for that is the jobs to be done philosophy, which is, nobody buys a 1/4-inch drill bit, they buy a 1/4-inch hole. What is the what is the objective or the goal or the pain that you're trying to solve for your customers? And it may be different than the explicit data that they're telling you. They may say they want a specific product, but then when you dig deeper down, it's because they're in their own mind, they're thinking in terms of marginal optimization, and you can create something new. I want to teach you 2 quick frameworks on how to think about this. One is called Quadrants, and the other is called Blue Ocean Strategy. So Quadrants, it's just a really simple way to visualize what you want to do. This is a way that I like to just think about life, right? So if the y-axis here is things that are good for the world, and the x-axis here is things that are good for you, you don't want to do things that are bad for the world and bad for you. Ideally, you want to do things that are good for the world and good for you. And I'm not here to weigh in on morality. So if it's bad for you and good for the world, that's fine. If it's good for you and bad for the world, that's up to you. But I wanted to teach you this because you can visualize the strategy and the value that you're creating for your customers and where you want to focus. So I'll give you the example of what I'm working on with the ad tech startup we launched a few months ago. When you think of, in my case, one-to-many, which is billboards, because we're doing out-of-home advertising, versus one-to-few, and brand-driven budgets versus performance-driven budgets. My startup is avoiding this phase entirely because it's sort of the archaic old industry, opportunistically focusing on, sort of these other areas, but we're really focusing on performance-driven budgets and one-to-few environments, like brick and mortars and that sort of thing. So this is a good way to visualize where you want to focus and the value that you're creating for your customers. The other way to look at that is what's called blue ocean strategy versus red ocean strategy. So red ocean strategy is about creating competitive advantage. Can you have a lower price? Can you have more features? That sort of thing. A blue ocean strategy is once you understand what your customers want, can you create a new market where competitors are either irrelevant or even better ecosystem partners? So I'll give you, again, the example from the startup I'm working with. These are sort of the main competitors in our space. Things that have a high volume of impressions, we're going to avoid them. Things that are like ROI analytics, we're going to improve them. And then the blue ocean is the things that you're going to create. And what I've done here is I've plotted across the x-axis the things that matter to my customers. So what are those jobs to be done? What's the faster horse, right, that they want? And on the y-axis here is how good each of these competitors are at each of these individual things. And so I have all of these different things that we're going to create, which turns these people into ecosystem partners and not competitors. The way you measure this is something called cohort retention, right? So cohort retention can be any metric. It can be website visitors, it can be revenue, it can be whatever the value metric is that you're tracking. The reason it matters, though, is because you may start, 2 different businesses may start the same, but if you eventually run out, like people stop using your website, they stop using your app, they stop paying you, you don't have long-term product market fit. You'll always lose some people, right? But because it's just not a fit for everybody, whatever it is you're building. But if you have what's called cohort retention is asymptotic to the x-axis, so you don't lose everybody, that's how you build a big successful business. I'll show you a more clear example of that from my friend Dan here. So, if we just went and launched a startup, we're good at sales and marketing. We can talk people into buying. We can figure that out. But if you're losing all of those customers eventually, you reach a point where you just can't sell faster than people cancel. And this is where companies tend to plateau and why it's so important to solve for product market fit before you start scaling your revenue engine. If you're always going to lose some customers, but if you never lose all of them, you end up with this layer cake sort of thing where you can continue growing steadily. Now, in this case, Dan has plotted weekly active users for the app that he was working on and the monthly cohorts in which they started. So the January 14 cohort, eventually you lose all of them here. In the January 14 cohort, he's not losing all of these users. And that ability to stack is how you end up growing. And like I said, it can be weekly active users. It can also be revenue, right? So monthly recurring revenue. Ignore this number here because this is from my actual pitch deck that we were working on. If you can grow, not just do retention, but grow from your cohorts over time, you can get this exponential growth effect. So Slack is really good at this. Slack is the communication app. They have, a lot of companies might have 99% retention or 50% retention. They have 147% retention. So every year, on average, their customers are paying them more than they paid them the previous year. And that's how you get that sort of exponential growth curve. Is can you not only retain your customers, but expand the value that you're extracting? And so, in terms of product market fit definitions, I have a two-sided marketplace because I have advertisers and I have screen hosts. For me, it's the retention of marketers who exhaust their starting account balance because it's an ad platform and refund their account within 60 days. So it's not just, can I talk you into spending money on my platform, but do you see enough value that we're able to exhaust the budget that you started with and you refund your balance with as much or more money because you saw the ROI, you saw the success of it. And then because I have a two-sided marketplace, I have two customers I have to keep happy in order for there to be value. So for us, it's business hour active user retention. So are people using our screens, our businesses using our screens to sell ads to advertisers? And again, that's just an applied example where it can be revenue, it can be weekly active users, whatever that moment of truth is that creates value for your customers is the thing you want to be tracking that you have retention on. So I'm going to be tracking over the next year what percentage of our advertisers exhaust their budget and load more budget in, as much or more budget in. So that's product market fit. Now we're going to talk about the second phase, which is getting the math to work. Because you can create something that people love, but if you can't create a business off of it, you're not going to be able to, if you can't create a profitable business off of it, you're not going to be able to grow. There's two terms here that are really important to us. One is the cost of acquiring a customer, or CAC, and the other is the customer's lifetime value, or LTV. Those two things come together in a ratio. Sometimes you'll see it called COCO, which is the cost of customer acquisition. It's the exact same thing. Or customer lifetime value versus lifetime value, it's the exact same thing. The way you calculate cost of acquiring a customer is you take the amount of money that you're spending on sales and marketing and you divide it by the number of customers you got. Relatively straightforward. A big mistake lots of startups make is they only look at things like PPC spend. They don't factor things like salaries. They don't factor things like, if you have a subscription to HubSpot or any of the other things that you're spending money on. You have to take all of your sales and marketing expenses. Every dollar goes on one side of the equation in your business. It's either CAC or LTV. You're either increasing the CAC or decreasing the LTV. The LTV equation is based off of how much people pay you and how often they pay you, minus your margins. So the easiest way to do this is for a subscription model, right? So let's say you have a $50 monthly subscription. Somebody starts it, they buy, they pay $50, $50, $50, and then they cancel after 3 months. Your customer lifetime value there was $150. Subscription models are the most predictable, which is why people tend to really like them, because you get really good at predicting what your customer value is going to be. But it's not just restricted to transactional models. So for example, Starbucks, which is a brand, it's a global brand, but started here in the United States, they have an average order value of about $6. And if you were going to use the average order value as how much you wanted to spend on sales and marketing, you might only say that you were going to spend $2 to sell a $6 coffee and sandwich combo. But because of how good Starbucks is at getting people to come back over and over and over, their average lifetime value when this study was done by Kissmetrics was $14,000. So if you're a Starbucks marketer, you're not spending $2 to sell a $6 coffee and sandwich combo. You're spending like $2,000 or $3,000 or $5,000 to acquire and retain a $14,000 customer. The ratio that you pick from your CAC to your LTV is really like a strategic conversation that you talk about with your investors and with everybody, with the other leadership at your company. But if you think of the customer lifetime value as this pie, this circle here, how much of this pie are you willing to give away in order to acquire a new customer? So you might be willing to spend 1/9 of the customer's lifetime value to acquire them. That's a ratio of 1 to 9, or 1/5 or 1/3. The difference this makes is that if you are spending more money, if you're spending, instead of $30, you're spending $100. It means you have more things you can do in your go-to-market model. If you're spending a higher CAC, you can generally be more competitive. You can spend more money on pay-per-click and advertising. You can spend more money on a marketing team and a sales team, etc. And you can either, if you want to be more competitive, you can either, optimize your CAC, find a way to, within this, 1-to-3 ratio, just get more customers at that ratio, or you increase the customer lifetime value. Lots of people don't focus enough on the customer lifetime value bit. What this gives you the ability to do is a lot of companies, especially SaaS companies like HubSpot, actually lose money to acquire a customer. So if the average customer is paying HubSpot maybe like $1,000 a month, HubSpot might spend $12,000 to acquire that customer. And then after a certain amount of time, say after 12 months, they break even. So that customer has paid us $12,000 and it costs us $12,000 to acquire them. And as long as we're good at keeping customers, then after that is your positive cash flow. This can get you in trouble. Again, if you're not good at keeping customers, you have to lower your CAC. And so there's a lot of leverage in figuring out what you can do with customer lifetime value. Usually, this is why starting with that revenue, your revenue model, tells you what kind of go-to-market motions you can do. So this is again from my deck here. ARPU is an acronym that means average revenue per unit. It's also called ARPA, average revenue per account. It can also be average order value, etc. It's just like, what is the average customer worth to you versus what sort of CAC can you afford? If you have a super low customer value, right? So Square, for example, they were targeting small businesses. They don't make a ton of money off of each individual customer. They can do things like, B2C SEO, you can do, viral marketing, etc. You can do paid acquisition. If you have slightly higher average revenue per customer, you can do things like HubSpot does. They've got, I think, probably 30 or 40 people on the content team now writing blog articles. They spend money on PPC. They can do all of this stuff, inclusive of this. And then if you have a really high average revenue per customer, high average LTV, it opens up more options for you. You can do enterprise sales. You can buy commercials at the World Cup. It just determines what level of go-to-market motions you can afford. And this is an important thing for startups to figure out, is when you're looking at your phase 1, product market fit, and then phase 2, how much are people willing to pay and how often are they willing to pay for it? So that customer lifetime value bit. If your lifetime value is too low, it's going to restrict the sorts of things you can do and how quickly you can grow. So a lot of times before you start scaling, which is the third phase we're going to talk about in a minute, you need to solve for how do you either get a more valuable customer who's going to pay you more or solve for that customer lifetime value. A lot of times in marketing, we look at this as a funnel, right? So we have the world of people who we could be interested in, then some people who end up talking to us and some people who end up buying. When you're doing a startup, you actually want to reverse that. Flip the funnel. You start with the customer lifetime value and then back into what sort of go-to-market motions you can afford. So if your customer lifetime value is $1,200 and you want a ratio of 1-to-3, that's a whole separate class of how you choose that ratio, by the way. The short version is when you're trying to grow really fast, you want this ratio to be smaller because you're not worried about profitability. You're worried about taking over the market. But if that's your ratio, right, that means you can spend $400 to acquire a customer. $1,200, $300, $400. You get that. If you have a 10% lead to customer rate, so every lead that comes into your business, every free trial, every free account, whatever that is, turns into a customer, that means you can spend $40 cost of lead acquisition, or COLA. If you have a 5% visit to lead rate, that means you can spend $2 on your cost of visit acquisition. So you started with your customer lifetime value here, and then you can work your way back into what can we do. At a $2 cost per visit, you can't spend on AdWords if the cost per click is going to be $3 because your business model falls out of balance. And so the question for most go-to-market teams, you can either increase, again, this customer lifetime value, or you can optimize the marketing funnel. So if you think about the top of the funnel, you spent $1,000 salary, program spend, whatever. You got 500 website visits. That means you spent $2 to get a visitor. That's your cost of visit acquisition. You got 500 visits for $1,000. Let me just skip to the rest of this. If you've got a 5% visit to lead, right? That means that you can spend $20, 10% lead to customer, $200 cost of customer acquisition. If you instead spend $1,000 and get 1,000 website visits, maybe you got better at targeting your PPC, maybe you invested in SEO, et cetera. That same like ratio helps you get a more favorable cost of customer acquisition because you've optimized the top of the funnel. Let me skip to one thing here. What I want to show you is the same model. So the cost of visit acquisition at $2, you spend $1,000 and got 1,000 website visits. If instead of a 5% visit to lead, you have a 6% visit to lead. So say you invested in conversion rate optimization or retargeting, et cetera. You add live chat to your website, always a good idea. That reduces your cost of customer acquisition from $400 down to $333. So it's not always about how do you get cheaper traffic. A lot of people focus on how do we just grow more traffic to the website. Very often you'll find the leverage in your business model is further down the funnel. So optimizing how many leads turn into customers or optimizing how many visits turn into leads. Then you can either keep your cost of customer acquisition at $333, or you can say, I'm okay with having a $400 cost of customer acquisition because it fits my model. And then you can have a higher cost of visit acquisition. And instead of shooting for $2, you can now shoot for $2.50. So I'll walk you through a practical example of this. This is my friend, Dr. Evans. He's a dentist in Florida in the US. He is a specialist and he does surgery. The average surgery is $1,000 and he nets 30% of that. His lifetime value is only one time somebody comes, because if anybody ever comes back to him, it's usually because he's getting sued. He's a surgeon, they're not supposed to come back. But that's his lifetime value. His profit for him is $300. Because he's a specialist, he turns lots of customers, leads into customers. You don't come talk to him unless you're probably going to be relevant. So that means he can spend $100 to get a customer in the 1 to 3 sort of ratio here. He's a specialist, so the lead cost is $25. Visit to lead is very high, again, because he's sort of niche, so he can spend $5. And so Yelp was telling him, well, it'll cost you $3 a click for us to send you customers. And he can afford up to $5 a click. So as long as the traffic coming from Yelp converts at this same rate, it fits within his model. $3, 20% visit to lead is, $15, something like that. It's less than the model that he can afford. So that's the funnel. Now, the next thing I want you to do is, how do you take the funnel and overlay it on top of the buyer's journey? So the buyer's journey, we tend to think of this like nice, simple, linear process where people go from awareness to consideration to purchase. And it's sort of similar to the funnel, right? There are more people who are in the awareness phase than are in the consideration phase. There are more people in the consideration phase than are in the purchase phase. You can see this is like visit to lead, lead to customer. The thing about customers and decision making is it's not quite that simple. People don't go through this nice, smooth little funnel. And so your marketing activities have to reflect that. So this is a framework that I built while I was at HubSpot, along with the folks at eBay, where we tried to split the buyer's journey into the phases of the funnel. So at the very top, you have sort of the relevance phase, right? This is where you're blogging, you're doing PPC, et cetera. You're getting website visitors or store visitors if you're a retail establishment, and some turning into leads. They're expressing interest. You know something about them. Obviously, you're not done here because leads don't make us money. And this is where we come up with one of my favorite quotes in the history of business. So Jeff Bezos, obviously the founder of Amazon.com, when they first started adding negative reviews to the website, his investors sent him a letter and basically said, Jeff, we know you think this whole internet thing is going to be big and all, but you clearly don't understand how to run a business because you make money when you sell things. So why would you do anything that would discourage somebody from buying something? And Bezos's reply was, we don't make money when we sell things. We make money when we help customers make purchase decisions. You can see this, for example, if you've been on Amazon recently. They add things like Amazon's choice. They let you rank by, or sort by the ratings, etc. They're trying to create these mechanisms that enable somebody to make a decision. And that decision-making process itself is not linear. What I like about this graph that we made with the folks at eBay, somebody goes from research to comparison to intent, but they can move back and forth, right? So I can be in the intent phase of getting ready to buy something, and then I discover something new. Like I find out about a new feature. One of the products I'm looking at says that it has SureSeal technology. I'm like, oh, I don't actually know what SureSeal technology is. Is that something I need to be weighting in deciding what to buy? And that may actually kick me back out into the comparison phase or the research phase of the buyer's journey. You see this a lot with abandoned cart nurturing. If somebody abandons their cart, a lot of marketers will just spam them with coupons, assuming they're in the intent phase, and the only thing that's required is for them to have a sense of urgency or a discount or something. That may not be the case. It may just be that they weren't quite ready. They didn't have enough information to make that decision. So while we model this as a funnel, as marketers and as startup folks, what I want you to think about is it's not your job to move somebody down this funnel. It's your job to identify what phase of the buyer's journey they're in and serve them the relevant experience. So if they're in the research phase, it's education-based. It's blog articles, it's buyer's guides, etc. If they're in the comparison phase, it's things that help them make a decision, give them a framework for evaluating. You see this on a lot of startup websites. You'll see these like charts that show, the features we have versus the features everybody else has, and the nice little X's and check marks. Or if they're in the intent phase, sometimes they need incentives. Sometimes they just need a reminder in order to get to where that purchase is. This is the bottom of the funnel that most people stop at. Now, obviously, we as super sophisticated startup people know that somebody paying you once is not where the battle ends. We focus on the customer lifetime value. So do they purchase over and over and over again? And then beyond that, one of the metrics that we can use to predict if they're going to repurchase are things like customer satisfaction. But the customer satisfaction metrics serve another purpose as well. So this is what's called a Net Promoter Score survey. And it asks the question, how likely are you to recommend HubSpot to others? 0 to 10. 0 being, I hate everything about HubSpot. 10 being, I love HubSpot and I'm going to recommend HubSpot to everybody. This is a predictive metric of whether or not somebody's going to remain a user. That customer lifetime value, that retention chart, that cohort retention chart, you want to create these metrics that predict whether or not somebody's going to be retained. But this is also a growth metric. I actually, every time I get one of these surveys from a company, I always give them a 0 just to see if anything happens. And I did this on TripAdvisor maybe 5 years ago. They sent me one of these surveys and I gave them a 0, and then they sent me an email saying, awesome, please share your review on these 5 other platforms. And I'm like, oh, really? I just said, I'm super unhappy. I'm zero probability to recommend you. And you just sent me a bunch of links to make it easy for me to share my opinion with the world. Your touch points should be based on the customer's implicit or explicit data. Conversely, by the way, so like if they give you a 0, create a support ticket. Have somebody reach out to them and find out what happened. First of all, you might be able to win them back as a customer. You might be able to turn them into a promoter, but at the very least, you might be able to mitigate, the negative, reaction that they have. Conversely, if they give you a 10, they say I'm highly probable to share. Don't just say thank you for your response and then ignore them. Give them an opportunity to. T-Mobile does this to me all the time. They text me an NPS survey, and whether I give them a 0 or a 10, they take no action. If I give you a 10, you should send me a link to, Trust Radius or G2 Crowd or some way to review you, or alternatively, say, cool, click this button to invite your friends, enter these email addresses and send it to people. The companies that are really good at this sort of thing are the companies that get that retention that's over 100%. Like Slack I talked about earlier. Slack's retention was 147%. And it's because they have an experience that make people happy, and they're good at retaining. And they're good at capitalizing on getting you to invite other people. So people who are in this like 8, 9, 10 bucket, getting them to actually promote their product or service to other people. And the interesting thing that happens if you're good at that is every time you acquire a customer, it makes acquiring your next customer cheaper. And that's where you get exponential growth. And so that completes the buyer's journey here. If you can turn customers into customers who have lifetime value by solving for the repurchase, upsell, cross-sell, resell, and then turn those people into promoters, those promoters actually generate more leads. And you end up with this virtuous cycle of your business model actually becomes more and more and more efficient over time. And then in terms of the unit economics, right? All of this stuff, this is your sales and marketing to where somebody buys the first time. That's your COCA, your cost of customer acquisition, or your customer acquisition cost. That's your metric right there. And then the LTV side of the equation, which not enough people focus on. If the LTV goes up, the CAC can go up. So if you're good at keeping customers, you can spend more money to get customers. Really focus, especially when you're a startup, on solving for this, because then if you go and raise $1 million or $5 million or $10 million in investment capital, every time you spend $1 on customer acquisition, it will make your growth actually go faster. It's like pouring gasoline on a fire at that point. So the third phase, getting the math to scale. So far we've covered, product market fit. Can you create something that people like and that they continue using over a period of time? Phase 2 was getting the math to work. So can you have a go-to-market model with sales and marketing where you can spend less money than somebody's going to pay you over the course of their lifetime and increase the customer lifetime value so that customers every time you acquire a customer, it makes your growth go faster. The third phase is, you've gotten to, again, investors don't want to give you $1 and get $3 back in your 1-to-3 ratio. They want to give you $1 million and get $3 million back because that's how investors work. So the third phase is what we're going to talk about right now. The first thing I want to point out is that not all customers are created equal. And you know this intuitively, right? All of us have gotten off of a call with a customer and been like, that customer just wasn't worth it. No amount of money they paid us is worth it. Or we have customers that are, hyper evangelists that are really valuable to us. They pay a lot of money. Or there are customers that pay a lot of money, but they cost a lot of money to get. Enterprise startups have this problem a lot. A customer might be worth $100,000, but they cost like $50,000 in terms of cost of customer acquisition to acquire them. And so the buyer persona exercise is not just a fun, narrative way to figure out who you're marketing to, who you're selling to, who you're creating value for. You segment your entire business. All your unit economics, your LTV to CAC, are going to be different. So this was HubSpot. This is literally a screenshot from back in the day. We had owner Ali was somebody who owned a small business. These are all their pain points, those jobs to be done I talked about earlier. They were super cheap to get, but they weren't very successful. Marketing Mary, mid-sized business, a full-time marketer, professional marketer. Owner Ali was not a professional marketer. They were more expensive than Ollie's to acquire, but they were professional marketers, so they were better at using the HubSpot software. And then we had the enterprise Aaron persona, which they pay us much, much more money, but it's harder to get, right? For a whole number of reasons we can talk about in a different course. The psychological motivations of an owner Ollie, where they may not understand marketing. And capital is very important to them versus somebody who's an enterprise person. There's an old joke that nobody gets fired for buying IBM. It was back in the 80s and 90s. The motivations for purchasing are a lot different in the enterprise space. So figuring out your buyer personas and then actually looking at your unit economics. So, I won't go into all of these details here. The things I want you to look at are the average customer lifetime value broken down by our personas, and then the CPA, the cost per acquisition, also known as the cost of customer acquisition, also known as the CAC. Word of advice, agree on one acronym you're going to use at your business, and just be consistent. Because depending on who your investors are and where they went to business school, people will use different acronyms, and it's just important that you know that they mean the same thing. But in this case, our owner Ollie persona here cost $1,000 to get. and their customer lifetime value was $5,313. And that's based on how much they're paying us per month minus their retention rate. Their retention rate was just lower. And so that's a 1-to-5 ratio, right? The Marketing Mary persona cost $5,000 to acquire and paid us a lot more money and had better retention. So the lifetime value is higher at $11,000, but this ratio is 1-to-2, whereas this is 1-to-5. And so the question is, which of those, can you grow in, this sort of paradigm versus this sort of paradigm, which has a different buyer persona, has a different cost, and has a different customer lifetime value. So you're going to have to do this exercise on your own, which is defining your buyer personas and then creating a way to identify them. What separates one type of customer from another, and then looking at your various marketing activities, what brings in somebody who's worth more to you in terms of their LTV to CAC ratio. In terms of getting the math to scale, so we talked about this earlier, the ARPU to CAC spectrum. There are different philosophies on this that have evolved, particularly over the past 5 years. If your average revenue per customer is low, you may end up with like a cash flow risk, and you may need to do what's called fast scaling, because you may have long CAC payback periods, et cetera, and so you may want to prioritize speed. If your ARPA is high, your average revenue per account is high, say you're Salesforce or HubSpot or something, the risk is different, right? Because you have these big customers that come in, especially in the beginning phases of a startup, where you might be waiting on a deal that's $100,000, and that creates different risk. And you want to be a lot more efficient, right? You want to make sure that you're not running out of money before those deals hit. Every startup entrepreneur has had to deal with this sort of thing. And then there's a third concept called blitzscaling, which is something that you probably don't want to do. I don't know your business, but it's there's a great book on it by Reid Hoffman. A lot of business models require what's called blitzscaling because they don't actually have value unless they get big. So Uber is a great example of this, right? Like Uber had to get big in order for Uber to be as valuable a company as it is. If Uber had just sort of grown cash efficiently, they wouldn't have created the value that they have because they have those sort of network effects. So there's just 3 different frameworks to think about, and they relate to the balance between your average revenue per account and your cost of acquiring a customer, or your cost per acquisition. In terms of the engines of growth, okay, so how do we grow? Inbound or outbound was like the way to grow for a long time. Is cold calling, telemarketing, etc. Also like interruptive-based ads, spam mail, spam email, etc. It's sometimes in some business models that still works, right? There are models in which outbound is still an efficient method of driving opportunities and customers for your business. Inbound is how do you drive traffic to your website? You convert them into leads. They go to your sales reps. They get worked. You connect with the leads. They become sales opportunities and then become customers. And then the last 10 to really 5 years has seen the emergence of what's called freemium or product qualified leads. So instead of somebody requesting a demo or starting a free trial and then talking to a sales rep, which would be the inbound funnel, or instead of me calling you and convincing you to request a demo, which would be the outbound funnel, people start using from the same traffic sources, organic traffic, direct traffic, paid, et cetera. Inbound and outbound gets traffic from the same places. But instead of them talking to a human being, they start using the product. And then based on their usage of the product, that qualifies them to talk to a sales rep. So in terms of what qualifies them, right? They may be usage qualified, so they may hit your limits on how much you're willing to let them use your software for free. Or they may just be hand raisers. So some people inside the product may request a demo. They've been using Slack, they've been using Flock, my previous company. They've been using HubSpot, now has a free option. And they may say, I want help on deciding on if I should use the paid version. So there are different engines of growth. Again, you usually are going to focus on one at a time because it's who chases two rabbits catches neither. But think about all of these in terms of their relationship to how much you can afford in terms of CAC and how fast you want to grow. The other thing I want you to keep in mind is that different channels are going to convert at different rates because of where they exist in the buyer's journey. So in this graphic on the left, right, Facebook is driving 35% of new users. AdWords is driving 25% of new users. And then if that's all you were tracking, where are my users coming from? You've got 15,000 users, 5,000 converted, 10,000 customers. That's interesting information. But what you will invariably find is that, for example, it might be the targeting you have, it might be where they are in the buyer's journey. Oftentimes people off search engines are further down the buyer's journey, they're more qualified. And so they may have better retention in terms of returning users. In this graph, they don't. I'm pretty sure I stole this graph from Facebook, so take it with a grain of salt. But Facebook is accounting for 42% of returning users, 40% of converted customers, and 42% of their returning customers. So Facebook is actually a disproportionately powerful and impactful channel that you want to invest in because you're slicing that cost of acquisition to lifetime value ratio with that buyer's journey, that virtuous loop that we covered earlier. You're slicing that now, not just by the buyer's journey or the stage of the funnel, not just by the buyer persona, but also by the marketing campaigns. Different types of marketing campaigns, different top of the funnel inputs are going to have different impacts. The interesting one here for me is Instagram, right? So in this fake example, it might look like AdWords is doing better than Instagram, but AdWords, if you follow it down, is only accounting for 3% of returning customers, whereas Instagram is accounting for 30%. Yeah, Facebook definitely made this graphic. All right, so there's one more concept I want to share with you, which is marketing attribution. All of us know that there's not one moment and one thing that influences decisions that we make. And remember, believe it or not, your customers are people too. The inverse of that is I used to threaten to tattoo "we are not the user" on the inside of my team's eyelids, because the goal is to think about the way that they make decisions and what's going to influence them. So you may have different marketing activities, your blog, email, display ad, they attend a webinar, and then they viewed the website pricing page, and then they became a customer. So if you were using last touch attribution, you would say what led to that revenue was the website pricing page. The issue is we know that's not entirely true, because the blog, the email, et cetera, this is what brought people in, this is what influenced them, and then this is just what helped them overcome that comparison and intent phase to actually become a customer. There's another mechanism, which is called U-shaped attribution, where you give more credit to what brought them in at the first touch, which they may have read your blog, distribute some credibility for the sale between the other things they did, and then some credibility or some weighting to the value of the website pricing page. And the reason this becomes important is because this is going to determine where you invest your time and your budget, right? So in this previous model, you're not going to hire a lot of content marketers. You're not going to spend money on display ads. In this previous model, you're saying that, like, okay, we're going to spend some money on blogging because we're giving it credit for 35% of a given conversion, and the website pricing page, conversion rate optimization, et cetera, we're giving them some credit as well. There's another mechanism called linear attribution, where you just say, cool, everything they did, I'm just going to split it up equally because I'm not weighting what influences people's decision-making process. The other one is time decay, which is based on how long it took them, I'm going to weight it, right? So the blog, if that happened 6 months ago, they found us by the blog, I'm only going to give it credit for 3%. And the reason credit matters, again, is because credit is budget. And so if somebody converts, you're going to say that, like, the blog drove 3% of that value, whereas the webinar drove 25% of that value. Now, I want to add the caveat that you can go absolutely insane trying to come up with different marketing attribution models. There's all kinds of technology out there that you can pay for. There are complex mathematical models. If you are a startup, which by definition the people on this webinar should be or are, or at least interested in startups, you probably don't have a statistically significant sample size to slice data too many ways. Every time you slice data, you reduce the sample size, right? So if I want to do it by buyer persona, and I have 3 buyer personas, and I have 300 customers, now my sample size is only 100 in each of those buyer personas, assuming it's evenly distributed. And that's not statistically significant. Then if I slice it by traffic source, Instagram versus AdWords, that's even less. Then if I slice it by the marketing activities that influence them, that's even less. So what I want you to understand is, as you grow, as you scale, which is why it's in this phase of the presentation, these are optimizations that will help you improve your efficiency and accelerate your growth. But too many startups get way too caught up on things like attribution models and slicing data too many ways. This is my suggestion for if you are a startup and you're growing. What matters is what brought somebody net new into your universe. That's what's going to fuel growth, because nobody knows who you are, sort of by definition. So you could do a U-shaped attribution, or you could do something super simple. But if you're going to do anything that's like super complicated, don't. If you have to pick one of these, I would personally pick first touch attribution, because what matters to me again is what's bringing somebody net new. When you're a startup, I didn't have anybody at Flock who was optimizing the website pricing page, right? So it didn't matter what credibility I gave it, because they weren't going to get any budget anyway. So the blog is getting 100% of the credit here. This will change over time, again, based on your life cycle and based on your goals. Is what is important to you optimizing the flow through the funnel, in which case you do care. If you want to optimize your conversion rates to the funnel, you care what influenced them. But if you have an efficient funnel, you want to know what's bringing somebody net new into your universe. I want to talk to you about a few other metrics before we wrap up. If you have a sales team, the whole visit to lead rate is basically the quality of the traffic that you're driving and your ability to do conversion rate optimization. The lead to opportunity rate and the opportunity to close rate, so the lead to customer rate, is dependent on the sales team. And when you are a startup, if you are the CMO, this is actually a screenshot from a workshop I do called Couples Therapy for Sales and Marketing Leaders, because sales and marketing leaders tend to bicker worse than husbands and wives do. I actually track how the sales team is forecasting, because different types of leads will close at a different pace and a different value. So if the sales team is forecasting low for the month, I'll actually stop trying to get new blog subscribers, and I'll have the marketing team focus on driving maybe demo request leads, because they close faster. And as a startup, we really want to be disciplined in our cash flow. So we want to make sure that we're hitting our quota every month. So, okay. When you have a small sales team, by the way, resist the urge, just like with the marketing attribution, resist the urge to do very advanced lead scoring, because your sample size is going to be too low. They may try and sell you that software, but it's not worth it, because if you don't have a sufficient sample size, here in the month of January for this particular sales team, I drove less than 150 leads. There's no way to do advanced lead scoring off of 150 leads. I actually rely in the beginning phases on subjective feedback. Sales reps are smart human beings who want to make money. And I let them rate leads high, medium, and low. And I explain to them that if they rate leads high, I'm going to go find what buyer persona it was. I'm going to go find what traffic source drove them. And I'm going to try and bring them more of that. If they mark a lead low, I'm going to try and say, I'm going to find out the same thing. I'm going to go say, okay, that came from Google AdWords. I'm not going to do as much with Google AdWords. So this is where you get into, as you're breaking apart your funnel, can you create some of these leading indicators? This metric is to the lead to customer rate what Net Promoter Score is to customer lifetime value. It's a predictive, subjective metric that helps you when you're earlier on and you have a smaller sample size. common complaints about sales teams though is how quickly you attack a lead. So how fast do they call it, and then how many attempts do they make? Any good relationship goes both ways, right? So the marketing team is driving high quality leads. The sales team, the data that we had, our agreement was that they're supposed to make 6 attempts on a high or medium rated SAL or sales accepted lead. And the time I wrote this dashboard, they weren't quite hitting that. So myself and the head of sales had a conversation about that. So they're holding themselves to this metric, and that's not just a number we picked randomly, by the way. What we did was we looked at what's the inflection point in terms of how many attempts a sales rep has to make based on the probability that they're going to close that lead, right? So once they make 7 attempts on a high-rated lead, it's not really improving the probability that they're going to close that lead, but there's a huge difference between, they've made 3 attempts on a lead and 7 attempts on a lead. And so that's how we set that metric. And again, all of these numbers are going to be subjective to you and your organization. One other thing I want to point out, data, especially when you're a startup, look for aberrations. Anything that doesn't fit the expected pattern may not be bad. It might just be a different insight. And so these are 5 of the sales reps when HubSpot was super, super small. The 5 sales reps that I was tracking. And Peter, by the way, he was on vacation this month. It's not that he's just a terrible sales rep. But I was tracking like how many leads they each rated high and medium. And I noticed that Ted was making more attempts on medium rated leads than high rated leads. And because I was looking for any aberration in the data, because that doesn't make sense based on the data I showed you before, I went and asked him, I'm like, why are you doing this? And it's because he had come up with a different way to sell to medium rated leads. So medium rated leads in the nurturing sequence he was doing, he was actually closing them at a much higher rate if he made more attempts. And so I was able to detect this weird bit of data and then train the rest of the sales team on what Ted was doing so that they could close more of their medium rated leads. Whenever you're looking at data, look for aberrations. If you find an aberration, grow the sample size as quickly as you can and see if it sticks, right? If a specific marketing traffic source is converting at a much higher rate than all your other sources, try and grow the traffic from that source until you have a statistically significant sample size and see if that remains true. It may have just been an aberration, which is fine. You'll learn something. Or you may have discovered something new about your business model that you can then invest in. So there's one last, this is usually a build, by the way, thinking in terms of pipeline revenue. So it's not just, we're generating leads. Based on the average value of a customer, so say I was getting ready to propose to my girlfriend. This was back in 2011 or so, and I downloaded The Guy's Guide to Jewelry. I found their ebook off the internet. I downloaded it. If the average ring costs, we'll say $100, which it didn't, but let's pretend that engagement rings only cost $100, and 10% of the people who download this ebook end up buying. That means that each ebook download is worth $10. Right? So that's a very, very straightforward way of doing the math to say, what is each lead worth? That's the cost of lead acquisition that I told you earlier. And that is what lets marketing teams, this green line here is the sales team's quota throughout a given month. And the marketing team's job is to cover the sales team's quota. So based on all the different things that we're doing, we're assigning the different traffic sources, the different personas, the different conversion events. We're assigning them different dollar values. I'm adding those up on a daily basis, and I'm making sure that the sales team's quota is actually covered. If this blue line is trending below what the sales team needs, then what that means is that based on the historical performance of my funnel, the sales team is not going to hit quota. Ignore this, like, yes, I downloaded their ebook and yes, I bought from them, because usually there's a slide after this that says, yes, she says yes, picture of our wedding. It's great. One more thing I want to cover. The cadence at which you measure things matters. We've talked about statistical significance. We've talked about the funnel, the buyer's journey, buyer personas, etc. The things you can measure faster. Why I care about Net Promoter Score instead of just waiting 12 months to see what the retention was. Why I care about sales reps rating leads instead of just waiting to see if they close them? It's because the things that I can measure faster let me iterate faster. And the speed at which you are measuring and optimizing your business is the absolute speed limit at which you can improve and grow. If you're only measuring things quarterly, you can't optimize faster than quarterly. You can't, but if you're trying to measure things daily, it's a smaller sample size. It's harder to do. So that's the balance you have to take into account. And I'll show you, this is a screenshot from a planning doc I did. This was years ago. But basically, like, how much money are we spending, impressions, cost per impression click, the click-through rate on the ads, the visit to lead conversion rate, my cost per lead, all this stuff that we've talked about. What's the CAC? The CAC, I could only calculate monthly with confidence because this business had like a 3-week buying cycle. So I could calculate monthly. But the click-through rate on the ads could be optimized daily, right? Hourly if we wanted to. And so I had different, what's called a DRI, directly responsible individual. Like, I was the head of marketing. And so my job was I was accountable to the CAC number. And I could optimize that monthly. But I forget who MT was. That's a acronym for somebody that was on the team. But them and Harry, Metric Theory, they were an agency. So the agency and Harry had all these daily goals that they were reviewing that they were optimizing based on. And they were supposed to be getting better every single day. And then MK, who was running that team, her job was to make sure that these metrics were being solved for on a weekly basis, because we could solve for, the average time it took a lead to become an opportunity was 5 days. And so she should know within a given week if there's an aberration up or down. And so she would check that metric every week. And then I didn't sit there and refresh the marketing CAC data every day because that's not useful. I would refresh it every month. So one last thing I want to show you guys, cash flow. This is sort of a joke, right? Like, you buy money or you raise a bunch of money, you get Office, you get Max t-shirts, stickers, and then like later you get like your Amazon instances and your marketing budget's somewhere over here. Be very efficient with your cash flow when you're a startup, because you can grow yourself out of business even if you have a ROI positive LTV to CAC. This is a screenshot from, again, my startup that I'm working on right now, where I show the various expenses that we have versus the revenue that we have. And this number is how much money we've consumed based balancing revenue and expenses. And these are the assumptions that we're baking into our model, et cetera. Though we had a profitable LTV to CAC, if I only had $200,000 on hand, I would have run out of money, right? And so this is something important for investors to know and for you to know, which is how good are we doing at scaling or at controlling our cash flow. That's the end. I know I threw a lot at you. I gave you sort of a brief dive into a bunch of different topics. And what I'd love for you to do, you can reach out to me, sam@onescreen.ai. You can find me on Twitter. You can find me on LinkedIn. I do lots of mentoring and such for startups. I haven't been able to come back to Istanbul in a while, but I'm looking forward to answering any questions that y'all have either now or later.
We have a couple of questions. Just let me ask you, Sam. So in a blue ocean strategy, COCA and CLTV can be lower, or what is the A/B testing of setting this ratio for disruption into totally new market?
When you're launching a startup, is my camera on, by the way? Can you see me?
No.
No. Oh, let me turn my camera on.
Yes,
hey,
perfect.
What's up, everybody? When you're launching a startup, your LTV is a hypothesis. And so if you're launching a blue ocean strategy startup where you're creating a net new market, it's a hypothesis with a really low confidence interval. So it's something that you're going to iterate on while you're in phase 2. But it's something investors are going to ask you about, which is, you're saying, for example, my startup is saying that these screens will be significantly more valuable because of the technology we have that allows us to sell it to a new market. They're going to want proof of that, right? So it's not like I'm selling the same thing to a same market. They're going to want proof of that. And it's not really A/B testing necessarily, but like once I have the CAC model and then I'm validating the LTV model, then I can raise additional money and scale. So blue ocean strategy just increases the uncertainty because you don't have a benchmark.
Would you say B2C e-commerce platforms have network effects? What is the good LTV ratio for e-commerce business?
So they can have network effects. The definition of a network effect is, again, that net promoter score concept. Every time I add somebody in, it makes it easier for me to acquire somebody else. Or every time I add somebody in, it increases the value for the people on the network. So Facebook is a good example of a B2C network effect, because Facebook would be totally useless. In fact, I think all of us would leave Facebook if it wasn't for the fact that our family and friends were on Facebook. So in their case, they had to get big and have those network effects in order to be valuable. B2C e-commerce doesn't usually have a network effect because the fact that other people are on the network doesn't necessarily make me more likely to buy it, unless it's like Etsy or eBay or something that's more of a peer-to-peer, sort of value proposition. Or you can get really good at net promoter score and make it so, I don't know, offer a $1 coupon every time you invite somebody who comes and buys something on the platform. It's just harder to do. It's a weaker incentive, but it has to have one of those two characteristics in order to have network effects. You asked about lifetime value. It's just really unpredictable in a B2C model because it's not recurring revenue. But Amazon, for example, has a really high lifetime value because they've gotten good at, I don't even go look at other websites anymore. I should, because Amazon has its own issues as a company. But they've just gotten really good at training me that they're the place where I should go look. And I've got, I think, 4 Amazon boxes in my mailroom right now.
So other question was, would it be impractical for a seed stage startup to use Blue Ocean's method to show competitive advantage?
Not at all. That's exactly where you want to show it, right? Because you need to be thinking about this, and also your investors are going to be thinking about this, which is, there's already incumbents in the industry. You can either have something that you're selling to the customers in the industry that's better than the incumbents, or you can have a go-to-market motion that's so much more efficient than the incumbents that you're going to be able to beat them. Those two things are kind of unlikely when you're a startup going against a mature industry, right? Because it's not like back in 2005, I got a cigar website to rank for the term health insurance just because companies were bad at marketing back then. That's not the way the world is anymore. Marketers are pretty good at their jobs. So Blue Ocean strategy answers the question for you and for your investors. How are you addressing the existence of incumbents and the value that you're creating versus your go-to-market model? Absolutely talk about that and test that hypothesis in the early stages.
Sam, thank you very much for this valuable experience and also presentation. And we will be very happy to see you in Istanbul as soon as this COVID outbreak finished up. And thank you very much and have a great day.
You too. Thanks for having me.